guys. Okay, so we are diving into the section straight up. Welcome to the video. So we'll be doing most of the session with trading view now. Okay, so we're looking at liquidity for today, and yeah, we'll start off from liquidity. Quick explanation as to what liquidity is, and then we'll move on to the chart and we'll discuss swing highs and swing lows for today. So keeping it real, keeping it simple. For as the name implies, when we talk of liquidity, we are talking about where the money is in the market. Okay, liquidity, where there is liquidity, is where the money is. The bulk of the orders, where the people's money is, the market money is, where is the money at this particular point in time. So overall, we all have the knowledge that the market moves in trend, and in some cases it will move without following the trend. Now overall, what happens in the market is the market actually moves it just takes orders and it also takes out new orders while it's activating new orders. Or let's just say what the market does is mitigate orders. Okay, when we talk about mitigating orders, is in an uptrend, a market that is pushing to the upside. Okay, in an uptrend, majority of the time, this market would always have certain individuals that have interest in buying in certain areas of the market. And as the market continues to push up, people would continue to buy into it. Okay, so that on its own tells you that we have the number of persons always in the market, always looking for an opportunity to get into the market. Okay, and as a result of this, most times there are always orders that are not quickly filled. Okay, so while this is going up, there is always a buy limit somewhere in here that the market has to go back and peak, and for that this market has to find its way back down to trigger these orders and then move to the upside. This is one explanation. So the movement of price is as a result of orders that have not been activated. Okay, that is the word we can use, orders that have not been activated. But we both know, if you are already looking at, you are taking your time to look at your chart, you should know by now that the market trend is never this clean. Just as we have this drawing, is never this clean. So basically what happens in the real market is that when there is a push up, the smart money, which is the big banks, the Feds, the banks, the world banks, the hedge funds, what these people do is they want to be able to enter this buy, but they are not ready to enter at a high price. Okay, so if we were to drop a price tag on this price is, as you can see, this is 184.994. let's hit up the settings and see if we can increase the size. Okay, just to make it a little bit easier for us to see. As you can see there, we have this price tag as 184.994. in most cases, the banks don't want to buy here, they want to be able to enter somewhere down here, and that is 184.816. Now, being that these guys want to actually enter a buy at this particular level, they want to push the market that is way up at 184.99 down to 184.81. But they can't actually, if they should just push it down here and start pushing it up, everybody will take this trade and everybody will make money. And the banks, I wouldn't say the banks don't want you to make money, they want you to make money, but at the same time they want to make certain movements in price. Okay, so like I was saying, for the market to get to this level, for the banks to actually purchase, let's actually give a typical example. Say the banks want to purchase GBP, they want to purchase GBP, what they want to purchase $1 million worth of it, or let's say they want to purchase £1 million of in GBP, £1 million. Okay, if they spend this, it's going to get them about, in JPY, in Japanese yen, is going to give them 100 and it's going to give them 185, 150. Current price is 88, so we'll use 88. This is what it should give them. Let's hit up the commas so that it's a lot easier to understand. So this is what they should be able to afford if they have $1 million. But we know the banks don't do these amounts. The banks will do billions. Okay, this is what the banks operate with. So this is most likely what they want to do. In most cases, they won't even be doing, okay, let's just leave it at the billion. So it means the bank would most likely want to purchase about 1,850,888,000. Okay, and for them to buy this, they need to, they have this is what they have, but this is what they want to buy. For them to actually run this particular order, they need somebody that will be willing to sell this to them. Remember, what we do in this business is buying and selling. So when you are hitting a buy on your end, someone is hitting a sell somewhere around the world. Okay, so that is what the banks are going to be doing. Now, there is a very popular quote: find the liquidity. If you can't find the liquidity, you are the liquidity. What it means is that if you cannot find out where the money is, okay, if you're not able to engineer liquidity, then you'll be a part of the engineered liquidity. Meaning, know where the money is, know where it's going, know what the banks are buying, know when the banks are trying to engineer liquidity. If you are not able to do that on your own, then majority of the time you are part of those that are being engineered. Now let's talk about engineering liquidity. What is engineering liquidity? Now, for the market, for the banks to buy at 184.816, like we mentioned, they most likely would want to drive this price down here. But because they don't want us, the retail market, the retail traders, to know what is happening, what they are basically going to do is engineer liquidity, meaning they are going to create liquidity. Okay, for them, they are trying to create a liquidity where they have sellers of up to £1 billion. So what they are going to do is basically drive the market down sometimes in order to make people feel they want to sell. So automatically we're going to have a number of people selling this market. We're going to have late bloomers, the buyers that didn't buy early at somewhere down during this first move. Those people are going to see this as a retracement, immediately starts retracing, pushing back up. These people are going to buy, and when he's pushing in, a number of some other persons will sell, some will buy. This market drives down and tags out those that just bought, and those that just sold will be in profits. So majority of them will increase their orders. A number of others will still buy here, a number of majority again will still sell. And when it starts pushing down again, almost every seller in the market would be selling now, because now we have a lower low, lower high, lower low, lower high. So everybody would be getting in on this third leg here. Every single soul in the market, including you that's watching this video at this moment, I know you should have been selling now, feeling yes, lower low, lower high, it should drop down. But actually what the big banks are doing is trying to engineer liquidity. So they are trying to create liquidity for their buy. So now we have a number of persons selling, and automatically we should have a whole large number of sellers. So what basically happens would be that at this particular point in time, we could have enough sellers enough sellers offering about, let's say 1.1 billion. Let's work with that. And the bank comes in to buy it from them, but the bank doesn't have so much to buy everything. The bank just needs 1 billion, right? So the bank would mostly be spending, the banks, let's put in the banks here. So the banks would buy 1 billion. The banks would buy 1 billion off of what is available, and then you start asking, if the sellers were able to create 1.1 billion, what happens to the remaining 100 million? What happens is that me and a few of you, not a few of you, and the rest of us here that are all smart money traders, some that would become smart money traders and other smart money traders, we can then take advantage of this. Okay, we can then take advantage. Now, what I'm saying is not a typical example in the real life market. What I'm giving you is a typical example, sorry. In the real market is larger than this. It's larger than what I'm showing you. What I'm showing you is just a tip of the iceberg. Remember that in the market we do 6.6 trillion daily, so this could be a lot larger. We're just dealing with 1 billion. To get to a trillion, you need to get up to 1,000 of a billion. Okay, so moving on. So moving on here. So what now happens is the remaining of the retail, that is us, we will be able to take advantage of those of us that are able to know what smart money is doing. We can come in here when there is this 100 billion remaining. Me and you that understand how smart money works can come in and take advantage of this, and we buy in. So while the sellers are busy expecting to see more profits as the market continues to drop, as they're expecting to see more profits, what happens is the market changes direction and starts plummeting back to the upside. Okay, so this is the idea of liquidity and engineered liquidity. So what we have explained this very morning is what liquidity is and what it means for the banks to engineer liquidity. Now moving on, what are we going to be doing today? We're going to also be discussing swing highs and swing lows just after discussing liquidity. So yeah, moving on to the next video.